Hey everyone, and good evening, and welcome once again to Case by Case webinar by SMALLCASE in association with Kairos Capital. My name is Abel Matthew, and with me, I have a very special guest who's going to talk about something very special, simple, but also very important. Hi, Rishad. Please say hi to everyone.
Hi everyone. Thanks for having me here. This is a very important topic. I feel planning for your financial goals. It's the building blocks for getting started with your money.
Yeah, I mean, like everybody talks about, having the financial freedom, retiring at the age 30. I think a lot of people have been talking about retiring since the age 30 for like the last 30 years, and people think it's a myth now. So people think that it's not possible or whatsoever. But I think everybody wants a side hustle. We see a lot of YouTube ads saying how to make money, how to do that, how to do this. But I don't think anybody takes the initiative or understands how to achieve their financial goals, or might not even know what their financial goals are in the first place. So that is why everyone, today's session is very important, very simple, but also very important is how to achieve your financial goals and how to plan for them. And I've been having a talk with Rishad for the past couple of days, and he definitely knows what he's talking about. So thank you so much, Rishad, to come out, on a Saturday evening, taking the time off when we could practically be, chilling, but you came here spreading value to all fellow investors. It really means a lot. So thank you so much for coming in, and the floor is yours. Go ahead.
Thank you, Abel, and thank you to Small Case, and thank you to everyone. This is a subject I'm really passionate about, and so I'm very happy to be here today. Just a couple of disclaimers before we get started. So this the content is kind of designed to be general information only and for your education. And so if you need any professional advice, this is not personal to your situation. So, but you can definitely get in touch with your advisor or do your own homework before making any investment decisions. With that, let's just get started. As Abel said, I'm Rishad. I have a firm, Kairos Capital, which is a SEBI registered investment advisor. Our goal is to simplify personal finance for you. We advise on all investment products, including mutual funds, stocks, and most importantly, small cases. I came back to India about a decade ago and joined a bank as an investment advisor. And when I came back, what I noticed in new portfolios that I used to see, or portfolios of new investors, was that they were unnecessarily complicated. They had like 15, 20 different mutual fund schemes, 50, 60 different stocks. And most importantly, there was no real coherent strategy in place behind the investments. So they kind of were all over the place. In the run up to this webinar, Small Case kind of did a poll that asked whether people had an investment strategy behind their investments, and 45% of the people who responded either did not have a plan or had not even thought about it. So this is why I kind of decided to set up my own company to give financial advice from a first principles approach, trying to simplify personal finance for people. And so where does this approach start? It starts with a financial goal. So why financial goals, right? Why are they so important? Essentially, financial goals can help give your money direction. When you have a goal, you can create a plan and you can work strategically to meet that plan. Rather than worrying about, the ups and downs of the market, you can plan for a vacation to Goa. You can plan to buy a car. You can, if you want to set up a business, all of these things require money. So once you set financial goals, you can actually create a plan to meet those goals. Goals can be very big, like Abel mentioned, like retirement or financial freedom, or they can be much smaller. They can be something as small as, you wanting to save up for a phone 3 months down the line or 6 months down the line, or even buying a laptop or something like that. So, before we move any further, I would like for each one of you to really think about it and write one financial goal that you have in life in the comments of the webinar. If you can think of 5, then even better. So Abel, maybe if we can have 60 seconds on the clock, I would love to hear what people are saying. Probably try and get more interesting answers. Everyone has a retirement goal. So what more is there out there? So let's maybe start 60 seconds. All right, so all right, so retirement planning is definitely one of them. That's very good. That's a very good start. All right, Shashank has retirement planning. Bridge has a goal for wealth creation. Vikas, great job, 5 lakh portfolio in the next 2 years. Gaurav has for higher studies. Anvesh has for children's education within 15 years. That's an important one. Ashutosh Sharma is financial freedom at 45. Wow, that's awesome. Shubham wants to plan for a laptop, home, travel. Akhil wants to plan a vacation and for his kids' education. Pankaj wants to save up 10 lakhs so he can invest in shares. And Gaurav wants to take up his own venture, and he's very much interested in farming. Oh, that's very, very cool, Gaurav. Very cool. All right. So I think that's about 60 seconds. So you can see from this how people have many different types of goals, and, just off the top of your head, you can probably think of 2, 3, 4. But if you really give it time, you can even come up with 10, 15, maybe even 20. But there's a smart way for you to define goals, and that's SMART. Goals need to be specific. So the more narrowly defined your goal, the better the steps you can take to achieve it. Your goal needs to be very measurable, right? So we had a couple of comments saying that, I want to save up 5 lakhs or 10 lakh rupees. So if there's a money value attached to it, you can actually track your progress against meeting a goal. Your goals need to be achievable or attainable and realistic. You need to have confidence that you can actually meet that goal. So for example, I may have a goal of buying an iPace in like a month's time, but that's probably not really going to happen. So you need to be able to be confident that with the resources or financial resources available to you, so your money or assets, that you can realistically meet a goal. And lastly, a goal should be time bound. And it's very important that a goal is time bound, because without a time value, a goal, you can lose motivation. You can go on saving forever, and then you won't really, you can lose your confidence in achieving a goal. All right. So once you have a smart financial goal, what you have in hand is a money value and a time value, right? You can use these factors along with your risk and return assumptions to work backwards to calculate how to invest to meet your financial goals. So what does this really mean? Say, taking a very simple example, I want to save up 200 rupees, say 10 months from now. A very simple calculation is, okay, I need to save up 20 rupees for the next 10 months, right? 200 rupees. That's it at a very basic level. But you can get a little bit more interesting than that. You can also throw in your return assumptions to arrive at a much better conclusion. This is where the attainable and realistic aspect of the SMART goals comes into play. So, we all may, it's all well and good to say that, I want to save up 200 rupees, say 6 months from now, and my strategy will be save up 100 rupees and then I'll double my money in that much time. That might happen, maybe not. But if we bet on that and that's how we, plan for it, then we are setting up ourselves up for disappointment, because what happens if that doesn't happen, right? And so it's important that we be realistic and make sure that our goals are reasonable. So how do you select the appropriate portfolio for your goal? Now, we have a chart in front of us where you have a couple of different risk appetites, time horizons, and strategies. I think for the moment, let's just look at the middle three and just forget about the two on the side. When you start thinking about your financial goals, you need to first understand what is your risk appetite. Are you a conservative investor? Are you looking for something that is, steady and has less volatility? Are you a growth investor? Do you want your portfolio to grow faster? And you're willing to take the trade-off of additional risk. Everything in investing is risk and return, right? What are you trading off? Or are you somewhere in the middle? Are you a balanced kind of investor? Once you have your risk appetite in mind, then you actually try and figure out what is the time horizon of your goal. Remember, the financial goal has a money value and time horizon. So basis your time horizon, you shift down the bucket you are in to meet, depending on the financial goal. And in fact, if you are in a bucket which is less than 3 years, it's probably better for you to be in purely fixed income options. And why is this? Because, if you look at equities, if you look at gold, if you look at any growth assets, they can go up and they can go down, and and that can happen in a span of time, in a short span of time. When we're looking at periods less than 3 years, the volatility, it is not for sure that you will be able to meet your goals using growth assets, because the sudden market volatility can come in and mess up your plan. As your time horizon increases, though, you can take a little bit more risk. You can start adding equities and gold to the portfolio, and the longer time horizon you have, the more risk you can afford to take, but only up to the point of your own risk appetite, right? So between these four kind of buckets, you should comfortably be able to take care of most of your financial goals. You don't really need to move much more out of that. But there are certain investors who want to be more aggressive and who are willing to take the risk. And for those, the long-term returns of equities are very hard to beat. As long as you're comfortable with the risk, then that's the way to go. But you need to keep a long-term time horizon in mind. So now let's just get into each of these strategies. Let's talk about fixed income, let's talk about asset allocation, and let's talk about investing in equities. When we start with fixed income, if you walk into a bank branch today and you ask them to book an FD, they'll give you a table of many options. Have you noticed that, every option has an interest rate and a time horizon? You may have noticed that as the time horizon increases, the interest rate that you get in your FD goes up. So in today's low interest rate environment, the longer the tenure that you have, the higher is the yield that you will get. Now, what is a bond ladder? A bond ladder is actually a very simple strategy of buying bonds at equal intervals linked to a time horizon. What does that mean? So if I have a time horizon of, say, 5 years, I break up and buy bonds of 1 year, 2 year, 3 year, 4 year, and 5 year. what is the difference between buying a 5-year paper, right? There are certain advantages of constructing a bond ladder for the investor. The first one is liquidity. Rather than have a bond locked in for 5 years, it's better for you to have 5 different buckets, because you can actually then manage your cash flows much better. You have liquidity coming in and out, and so you can exit and re-enter depending on your preference. The second is for interest rates. So if you buy a 5-year bond today, you are locked into that interest rate. But what happens? I mean, interest rates are low today. What happens when interest rate goes up? So when interest rates go up in a bond ladder, I mean, you will have a paper that is maturing pretty close, so in say 1 year's time. So when it matures, you can reinvest that bond at a higher rate. So you can benefit from the the higher interest rates. Now, what happens when interest rates go down? And this is a trivia question. So the first was, I hope, like fastest fingers first. What happens to bond prices when interest rates go down? Abel, maybe we can post that question into the comments. And if you can let me know who's the first. All right, so giving it a few more seconds. All right, so we have a number of answers from Gaurav, Rohil, Akhil, Girish, Daita, who have all said, except Girish, that the bond prices go up. And that's right, when your interest rates go down, your bond prices go up. So essentially, when you create a bond ladder and you have multiple, bonds, and the interest rate goes down, the entire price of bond ladder goes up. So in this way, a bond ladder is as close as you can get to a passive all-weather strategy in fixed income. Congratulations to Daita for being the first to answer correctly. All right, so let's get into asset allocation. Asset allocation at its most basic level means not putting all your eggs in one basket. I mean, what happens, right? If you have all your eggs in one basket, you drop it, but you're gone. So what is an asset? Equities are an asset class, be it international equities or domestic equities. Gold is an asset class. Fixed income is an asset class. Each and every asset has a different risk and return profile. And each one outperforms in any given time. Like, there's no one year where a single asset will always outperform. Each one has different performances every year. So you can put together a prudent mix of each of these to achieve your risk and return objectives. There are many, many ways to build wealth over time, but few are as time-tested and reliable as passive investing using asset allocation. All right. So compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Who is the famous person who said this quote? Abel, can we have maybe in the comments, if you can just let me know who you thought said this? And here's a tip, he's not someone from the finance world. I guess I kind of gave it a little bit away by saying it's a he. All right, so Shashank and Ashwin said Einstein, and that's correct. Varsha also said Einstein, so that's correct. So yes, compounding is the best thing you can do for your money, especially when you give it time. So let's get into how you can compound your money using equities. There are very few assets that can beat the long-term returns of equities. And that's why whenever we talk about equities, we talk about long-term compounding of equities. There are many strategies that work for different equity investors. At Kairos Capital, we prefer the approach of buying good quality companies that invest their capital smartly, and we hold them for long periods of time so that that compounding effect can work in our favor. Now, just a disclaimer here, neither of these companies on this chart here, Mahindra and Maruti, are in any of our small cases. This is not a recommendation to buy, sell, or trade any of these scripts, and it's purely to serve as an illustration and as an example for your education. How do you distinguish between two quality companies? Mahindra and Maruti, both of them are well-reputed, good quality companies. How do you distinguish? One indicator that you can look at is the return on invested capital. The return on invested capital is a measure that tells you what returns the company is making on every rupee of capital that it invests in its business. This is different from ROCE. You may have heard about ROCEs in investing. In that, as compared to the ROCEs, it takes out the cash component. So there are many good quality companies in India that are proudly debt-free and that actually have a lot of cash on the books. A prime example of this is Maruti, right? That cash tends to be a drag on the return ratios of a business. So that's why ROICs is a very good measure, because it takes out the cash component. And so you can really tell how much is the return that the business is generating. So let's look at this chart here. Okay, in the first half of the decade, from FY10 to FY14, Mahindra had roughly stable ROICs, roughly 11, 12, 13%. And you can see that over time, they've had steady growth. What happened after that was that their ROIs actually fell quite a bit to 7% and then stayed about there for some time. And that kind of led to, a flatlining. And then by FY20 again started falling. When you contrast that with Maruti, right? Maruti had ROICs of pretty high, 33 and 36%, but that fell to 15%, that halved. So you can see that Maruti has actually underperformed Mahindra in that time. But what happens next? You see that the ROICs go from 15% to 22% to 50% to 83% to a mind-boggling 140%. And look at the chart of returns during the same time. I mean, you can see the returns are there for all eyes to see. Does this mean that Maruti will, in perpetuity, always outperform? No, definitely not. The ROICs again started falling after FY18, and you can see that the stock price has come down. What happened here? Maruti is a purely four-wheeler consumer business, and it is just focused on that. It knows that. In contrast, through this last decade, Mahindra has done a lot of mergers and acquisitions. the company has a lot of investments on its book, but those investments are not generating a good ROI. So here I'm going to ask a little question about Mahindra & Mahindra for those that track the stock. In June of 2020, the company made an announcement, for all. And since then, the stock price moved from 300 to about 900. Can anyone tell me what happened here? For those that track this stock, why don't you put it down in the comments? Anyone who tracks the auto sector, or who looks at Mahindra & Mahindra? Just a hint, it has to do with, the slide that we're talking about right here. Rohil is pretty close. He says SsangYong Motors disinvestment. Yes, that's correct. Some answers related to being in the EV space. Not exactly. Quite close though. Joint venture with Ford, no. And yeah, okay. So SsangYong Motors sale. Yes, that's correct. Actually, in June of 2020, the company announced that they were going to exit loss-making entities, primarily a lot of their international acquisitions, and they would continue only those businesses that had a clear path towards a minimum ROE of 18%. And though they would exit those businesses that did not meet those ROE or ROE thresholds, or that were not strategic. So what this really means is that the company was ensuring that all their investments that they had was generating a good ROI, or at least a minimum ROI, so that they were able to deliver better returns on the capital employed. And so, this is kind of a testament, right? So the focus went on ROICs, and then the stock shot up. So that shows you the power of how you can use ROIC as a measure that even within quality companies, the returns of invested in the business can change over time. And this is one tool that can be used to figure out what is going on. All right. So now you have an overview of how you can link your financial goal with your investment strategy. As a recap, you must first understand what is your risk appetite. Are you conservative, balanced, growth? And then you should downshift based on the time horizon of your goal. At Kairos Capital, we have 5 small cases that are available to you to help you invest for any financial goal that you have in mind. We have a Kairos bond ladder, which is a purely fixed income product. We have 3 asset allocation small cases, which range from conservative to balanced to growth. And we have a Kairos compounders pure equity portfolio. Each of these portfolios have been created with a specific risk and return objective, and they've been created with a specific time horizon in mind. And you can see that here on the chart today. All right. Before we close out, there are some important points to forget, to remember when you are thinking about your financial goals. The first thing is that there are two major financial goals that are applicable to most people. The first is an emergency fund. When we are, roughly a year from when the lockdown started. And during that time, many people suffered financial difficulties. An emergency fund is very important to have because it can act as a buffer and help you relieve any financial strain that you have. The second thing that is very important is to save for retirement. Yesterday, SmallCase did a poll where they talked about, how like by when do you want to be financially free, or by when do you want to retire? And the results of that poll today show that 80% of the people want to be financially free by the age of 50. Now, let's assume you are sitting, today you are at age of 25. I'm just assuming that. Okay, and that you want to retire at 50. That means you have 25 years to save up some corpus for your retirement, right? But what is your life expectancy? Your life expectancy might be 95, maybe 100, right? So if you retire at 50, let's say that you need to have 45 years worth of your money needs to last you for 45 years. What you don't want to do is have your money run out before you go out. And this is why it's very important not to put off saving for retirement. Finally, it's very important to rebalance your portfolio regularly because it helps keep your portfolio healthy over time. When we talked about rebalancing as part of asset allocation, I forgot to mention that rebalancing is very critical because essentially what it means is that you keep bringing your portfolio exposures down to a right balance. When something goes up, you sell it, and if something has gone down, you add money to it. So in a sense, asset allocation becomes a default way of timing the market. Okay, so thank you. I hope you've been able to learn something today. We just now talked about retirement funds, sort of retirement planning and emergency funds. If you want to know kind of how to get started with those, we have, you can visit our website, kairoscapital.in, and you can look for these two little drawings on our website, and they'll point you to worksheets which you can download, and you can write on them and try and that'll help you calculate how much you need to figure out for your retirement and for your emergency funds. You can also follow us on our various social media handles, and where we are putting out a lot of content related to personal finance. In the movie The A-Team, Colonel Hannibal Smith said, "Give me a minute and I'm good. Give me an hour, I'm great. You give me 6 months though, and I'm unbeatable." So in the beginning of this webinar, you had 60 seconds to come up with a financial goal. You've now had, well, maybe not an hour, you have had half an hour to become good at understanding how to invest to meet your financial goals. So my challenge to you is to come up with 25 goals to make you unbeatable on your path to financial freedom. And even if you don't do that, or you can't come up with 25 goals, we have a promo code on 25 goals, and you can get 25% off on any of our small cases. One more thing, if you actually have an active SIP in any of our small cases, you can get in touch with us, write to us, and we will be happy to help you plan for one financial goal. That's it for the presentation. Abel, I think we can maybe start taking questions. So if you guys have any questions for me, do put it in the comments below, in the YouTube comments. All right. So Gaurav asks, how should one invest in these in the low interest rate environment? Assuming interest rates would go up from here and bond prices would come down, then how should we go about investing in fixed income? So Gaurav, there are many ways. When you talk about fixed income, my preference always is to buy the highest quality. Uh, you can always take higher credit risk, or you can take look at longer durations where you get higher yields when it comes to fixed income. Uh, my preference generally is not to do that. For the time horizon, it's always better to link it with your financial goal. And for credit risk, it is a bit risky and very risky for most, because we've seen what happened with the Franklin funds and all in the last couple of years. So unfortunately, when you have a high credit quality, the return is what it is. As I mentioned in the presentation, when you have a bond ladder, it means that as the interest rate goes up, you can reinvest in the fresh papers at a longer duration, which can give you exposure to a much higher interest rate in that much time. So that will provide some buffer to your portfolio if you keep it, a shorter term kind of horizon in terms of your bond ladder. Shashank talks about emergency funds should be based on your monthly expenses or your monthly income. Actually, you can do either, Shashank. It actually, the emergency fund is about what will make you feel comfortable, what will make you feel safe. If you want to, so for example, just imagine tomorrow, what happens if your money cuts out, like your income cuts out? What do you do? Do you want to continue your investments going, or do you want to just make sure that you can take care of your expenses for the next, say, 6 months, 9 months till you can get back on your feet? So that's definitely, both approaches work. You can start with your expenses, and then you can even build up a bigger buffer using your income. Aditi talks about KAIMO 001 doesn't have a rebalance schedule. Yeah, that's our Kairos Compounders portfolio. I think that's what you're referring to. So essentially, the Kairos Compounders portfolio is structured as a very long-term portfolio with very little changes over time. We typically review the portfolio every quarter, but we don't really change things very much. So we haven't set it in the schedule per se. We are expecting to make some changes in April, but the idea being that this portfolio is meant to be buy and hold with very little churn in any given year. So that's why there's no rebalance schedule. Aryan talked about how is investing in the Nifty 50 index fund SIP for retirement. Aryan, it's best to take an approach which is diversified. Don't put all your eggs in one basket. Take an asset allocation approach. You should always kind of mix, take a healthy mix of different asset classes, including domestic equities, which could be Nifty 50, Nifty Next 50, international equities, gold, fixed income. You need to have a healthy balance. So I don't know what is your personal context. So what is your risk profile? So first start with your risk profile and then kind of decide what is the appropriate portfolio for you. So UK mentions how to plan how much SIP to have in a small case. So this is the key question, UK. You actually have to start first from your goal. So you need to map out. So for example, if you need to figure out how much you need for retirement, work out. So how many years of retirement, how many years of retirement do you expect your savings to last for? And work backwards from there, always inflation adjust, to come up with a corpus that you need. Once you know what is the corpus you need, then you can kind of map out the SIP that you need to do to save for retirement. And if you need help with that, get in touch with us. Daita says, I'm going to retire next month. So Daita, this is a very personal question in terms of your personal situation. So, I wouldn't be comfortable advising on a public forum for your personal situation. You can definitely get in touch with us. Happy to help you out. Um, yeah, is there any software or product where I can view all my goals, allocations, and don't have to maintain an Excel? So typically, Akhil, the platform you invest in will enable you to see your portfolio, but it'll always enable you to only see your portfolio with, where you are with, if you are that you've invested through them. You can look at your NSDL statements to look at your investments. When it comes to your goals, there are some products out there that do offer that. Yeah, so TGB Nair says, if my current spending is about 1 lakh per month and I'm going to retire soon, how much retirement fund is needed for leading a life for the next 30 years? Yeah, so TGB, this is a very personal question. Get in touch with me, and we'll and I'll help you plan that out. When Pankaj Patel asks, when is the right time to use the money made in a mutual fund? Will an emergency situation ever arise? Pankaj, we never wish for an emergency situation to ever arise, but it always helps to plan for it in advance. An emergency is by definition something that we haven't planned for, right? So it's important to build up an emergency fund so that you can take care of any crisis, right? If at the beginning of Jan 2020, no one would have predicted that a COVID pandemic was going to hit the world and just stop everything. Uh, so almost like a black swan event, right? So you need to make sure that you can create some kind of buffer that can help you tide over those situations whenever even if they don't happen. It acts as a comfort factor. Bridge Dave says, you can start investing in IPO to create good amounts of funds. Is this strategy a good one? And then after, build a good portfolio. So Bridge, generally speaking, IPOs are a way for the promoters to make money rather than the investors to make money. Definitely, there are many that have listing day gains, but there are a lot that don't. As a young investor, it's very important to get your feet wet and to learn about the markets. Is that a recommended strategy? No. But it's very important for you to kind of learn about investing, about how the markets work, and find your own comfort with how you like to invest. All right, so we also have some compliments. So thank you to those, Naved and Nadeem. Yeah, thanks. All right. So any other questions that we have? Shashank says, thanks for the explanation about personal finance. Thanks, Shashank. Appreciate it. I hope people can really benefit from this. You know, if you need any help, do get in touch with us. We are always. This is a subject I'm really passionate about. Like people always take the approach that what is the return that I should expect, but actually the first question that should be asked is what am I trying to achieve by investing my money. And so when you take that approach, it can lead to much better results for you. All right. Rohil has a question on Bitcoin in India for wealth creation. So Bitcoin is a subject where we can talk a lot about. Um, in when you think about it, I mean, firstly, there's a lot of talk in the government about it being banned. So you should worry about the risk of that happening, even if it doesn't go through in the future. That might happen. But when you think about it in terms of an investment risk ladder, Bitcoin probably is the riskiest of the assets. So when you build a portfolio, you need to build a strong core, and then sort of experiment outside of that. And Bitcoin is definitely in the experimental section. So you need to be aware that you could lose all your money, although many people have made returns. So you should keep that in context. So the Akhil asks, the charges for small case mention 0.5% of investment annually. What is an approximate amount? So it means that whatever portfolio you have invested with us on a monthly basis, they calculate what is the portfolio value, and they take 0.5% by 12, and they charge you that fee. So for example, if you have 120 rupees, in any given month, that will be 120 times 0.5%, which is by 12. So it will become 10 by, it'll be like 5 rupees. No, it'll be like 0.05 rupees. So Aditi, thank you for the amazing compliment. Really appreciate it. I'm really glad that you were able to actually understand the approach to investing for your financial goals. So thank you for that. And I'm so glad it's made my weekend. All right. So, Akhil, I think maybe I just didn't explain it properly. So, if you invest 100 rupees over 1 year, it means that I will charge you 0.5 rupees for that entire investment, like in investment in a year. So, but that 0.5 is divided into 12. So every month you'd be charged 0.5 by 12 for the investment. I think if there are no other comments or questions, maybe Abel, should we wind up?
Yeah, I mean, I don't see any other questions that are actually coming up either. So I think we can slowly wind up. But before we go, Rishad, I just wanted to ask because like a lot of us, when we think about financial freedom, we think about side hustles, especially now with all the the gig community. People don't
Yeah,
want to work a 9 to 5 anymore. They want to be like a freelancer.
absolutely.
They want to take projects. They want to be their own boss. That kind of a thing. So even though the topic is very simple about achieving your financial goals and living a life that is on your own terms, don't you think like the options are like too broad now, and you have to like actually keep your goals defined just to know what they are, because the
Absolutely.
options itself are very broad?
Yeah, today we have the options to do so many different things, right? And so and in fact, that's why, this 25 goals kind of challenge, right? You can literally, if you think about it, you can define 25 goals. But then do you have the resources to meet all of those? That's a question. You need to prioritize what you really want to do, what is really important to you, and be very strategic about meeting that. Because in that way, will get a lot of satisfaction, because you are trying to achieve what is most important to you in life. Um, you talk a lot about passive income streams, right? The only way for you to build up more savings or a bigger corpus and to do it earlier is to increase your savings rate. And you can do that in two ways. You can either increase your income or you can reduce your cost. Finite games versus infinite games. If you reduce your spending, that's a finite game. You can't get it down to zero. Literally, you can't spend zero. Uh, but increasing your income, that's an infinite game. So, there are many ways for you to increase your savings rate or to increase your income and to really invest, to be able to achieve your financial goals. What really matters then is, are you prioritizing them correctly? Have you defined them correctly? And are you investing correctly to meet them? I think that's the approach that should be taken.
Got it, got it. I mean, makes a lot of sense because it's such a simple topic, but it goes right above the heads of most of us. Yeah. So I mean, it's really great that you're trying to simplify investing the way that you are, and I really thank you so much for coming in. But before that, I just wanted to ask you. So with each publisher, we ask this: what's the meaning behind the name Kairos? So when you say Kairos Capital, what's the meaning behind
Oh,
Kairos?
yeah. So Kairos is a Greek word. It means the opportune moment. And so Kairos Capital is like the opportune moment to invest. Um,
Got it.
that's where it comes from.
Got it. Got it. Got it. Wonderful. And if you could also talk about the promo code and what you guys are offering once more before we leave today.
Yeah, sure. So we have a promo code 25 goals. So if you put that into any of our small cases, you'll get 25% off um, on the pricing. And additionally, if you do an SIP in any of our small cases and get in touch with us, we will help you plan for one financial goal. Um, yeah.
Great, great. So, guys, before we leave, another thing to say is that about the promo code 25 goals, you can find it in the description box below too. And to find Kairos Capital small cases, please go through the link, and it's also given in the description box. They have a wide variety, as Rishad said, based for different risk appetites and based on different financial goals. It gives you broader opportunities and broader baskets. So please go through, please check it out. Thank you so much, Rishit, for coming in today, especially on a Saturday, evening, and it really makes a lot of sense, and it's really helpful for a lot of people who are, trying to invest and trying to grow. And once again, I can't stop stressing about the fact that how simple this is, but also how important it is to achieve financial goals, especially in this day and age. Thank you so much, Rishad, for coming in. Any final words for our fellow investors?
No, thank you so much for having me. It's great to be speaking to all of you here today on a Saturday. And I truly hope that you become unbeatable when it comes to planning for your financial goals.
Great, great. So again, once again, thank you so much, Rishit, for coming in. Thank you, guys, for tuning in. So please subscribe to Small Case for more case by case webinars. And thank you so much. Thank you so much, Rishit.
Thank you.